This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think.
Hey, Steve Saretsky here. Welcome back to the show. We've got lots to touch on this week. We've got Canada's federal budget. I'm going to walk you through some of those numbers, give you some of my opinions on it. We've got an update on Canada's national foreign buyer ban, some big changes coming down the pipe. And then we've got some statistics out of the Vancouver housing market for the month of March. That's fresh data, unlikely to be reported anywhere else. So we'll give you first dibs on that, as well as some anecdotal conversations about really what's happening in the housing market. But I want to provide a message first and foremost, the core message of the show from the get-go, going on since inception 7-8 years ago now. It was always about providing, an opinion on the housing market, and whether it was good news, bad news, I was willing to share exactly what's going on in the housing market. So if you're a housing bear right now, I'm going to tell you, you may feel free to turn this video off, change the channel, because I don't have good news for the housing bears right now. First and foremost, we got Canada's federal budget. The Bank of Canada trying to fight inflation. You've got the federal budget comes out. People saying, okay, well, maybe they're going to slow their roll. That was certainly what the Liberal government had come out and promised about 6 months ago prior to the budget. And we actually got the opposite. So you ramp up an additional $43 billion in net new spending over the next 4 or 5 years. So Canada is projected to run a budget deficit this year of $43 billion, $43 billion with a B. Just for a little bit of context, in 2009, post-global financial crisis, Canada ran a budget deficit of about $55 billion. So we're running essentially very close to crisis levels of deficits of government spending. Now, again, yes, dollars have changed, inflation, etc. But keep in mind that $43 billion that they're expecting to run is predicated on the question mark is what is their tax revenues going to be? Because that deficit could easily go from 43 billion to, let's say, 50 or 53 billion. And then you're right on par with 2009, because they don't, the government, the federal government is basically projecting a very, very soft landing. And so, if you continue to get, let's say, a roll-off in new housing construction, if you continue to get softness in housing transactions, that can play an important role in, the capital gains taxes that the federal government accumulates, et cetera. So revenues are likely to be overstated. So that budget deficit, I think, is probably going to exceed $43 billion. But the message you have to get here was there was very little restraint in the amount of spending that the government is projecting, not only this year, but in this next couple years ahead. And that's actually going to make the Bank of Canada's job more challenging. Remember, the Bank of Canada is trying to rein in inflation. They need some softness in the economy. So if corporations and households are pulling back on their spending, but the federal government is in fact ramping up their spending, that makes their job harder. For example, cutting checks for people to go pay groceries. That basically offsets a lot of the work that the Bank of Canada is trying to do. So we could end up being stuck, ironically, with a higher for longer overnight rate from the Bank of Canada. You could see that interest rates stay elevated for longer because governments refuse to pull back on this inflationary deficit spending. What was interesting is you don't really see too often a mainstream bank economist sort of dissent from the message that they're basically told to put out there. But we had an interesting message from Scotiabank's chief economist. This is the guy, kudos to him, that actually called the aggressive rate hiking path from the Bank of Canada last year. I believe it was the beginning of 2022. He actually called for 8 rate hikes, and even he was wrong. We far surpassed 8 rate hikes, obviously, but he had the most aggressive call at the time. kudos to him. I actually had ridiculed him at the time, but he's out with another bold statement this week saying, quote, in a broader public policy sense, Ottawa's housing strategy remains confusing. The Bank of Canada is trying to contain inflationary pressures and soften previously raging house prices. The feds have thrown open the immigration doors into a market with no supply, while another tax subsidy to housing starts up on this Saturday, in the form of a first-time home buyer's tax-free savings account that allows one to shelter up to $40,000 tax-free with annual contributions of $8,000. Housing is going to rip after a temporary retrenchment, and there goes the Bank of Canada's efforts. So he kind of summarized it. Now, I do have some beef with the first-time home buyer's tax account of $40,000. I don't think that's going to move the needle, especially in these high-priced markets like Vancouver and Toronto. But his point of opening up immigration door to 1 million people without having a housing supply response or plan, and then adding fuel to the fire with these massive budget deficits and huge spending into the economy, is a boon for housing. It's unbelievable. I think the incompetence at the higher level, doesn't seem to be any sort of logical thinking through this. You cope that, and then you go, okay. We also had an easing of the foreign buyer ban this week. If you're a foreign student here, if you're a temporary worker, which again, think about it, Canada immigrated 1 million people into this country last year, 1 million people. Over half of them were non-permanent residents, aka foreign workers and foreign students. So the foreign workers now have the ability to purchase real estate. They're allowed to buy one residential property in Canada now, so long as they are here working and I believe they've applied for a PR that allows them the exemption of the foreign buyer ban. They also made some of the issues around new development. Kudos to them, at least. Is what was happening was developers locally, let's say here in Vancouver, when they're building $100 million project, $100 million condo project. A lot of the times, the capital, some of the partners, some of the investors in these private corporations are in fact American citizens, and let's say they might own 5, 6, 7% of the company, and because they are foreigners and they make up larger than 3% of the company, they're not allowed to acquire residential land, which is often residential land rezoned for multifamily buildings. They were not allowed to purchase residential land and thus not build new housing supply. So you can see where this was not very well thought out policy from the get-go. So they've amended that rule to say, okay, yeah, if you're up to 10% of your company is of foreign capital, then you can still deploy it, buy residential land, and build new housing. Thank God for that, because we are, again, chronically underbuilding in this country. We've tried foreign buyer taxes, foreign buyer bans, empty homes taxes, Airbnb regulations, speculation taxes, increase the property transfer tax rates, and now we've increased interest rates, and housing continues to sort of churn higher. In fact, looking at some of this recent Vancouver data for the month of March, you're going to see sales muddle in, chop around. Really, we don't have the lowest levels since X, Y, and Z, but it'll be one of the softer years in the last 10, 15 years. So sales volumes relatively weak. 2019 was weaker. 2009 was weaker. So there's some weaker years. But the big story continues to be new listings. So new listings were the lowest levels for the month of March since 2001. So the fewest number of new listings coming to market for the month of March since 2001. You'll remember in February, it was this exact same story. So this is a trend now. This is a trend of chronic undersupply of new inventory coming to the market. If you look at the number of homes that are currently for sale in Greater Vancouver, it's the lowest levels that we've got on record of data going back to 2004. And so currently, the number of homes that are actively for sale listed on the MLS system is lower than March of 2016. That was the previous low. So if anyone was active in the housing market or can recall, March of 2016, was basically the blow off top in the Vancouver housing market. It was when we had all that foreign capital coming into the market. Prices were accelerating from sort of towards, the middle parts, end of parts of 2015 into 2016. Explosion higher before ultimately peaking later in 2016. And then the foreign buyer tax was implemented several months later that year. And so we're currently running inventory levels lower than March of 2016. And so I can tell you, it's starting to show up in the data, but anecdotally, home prices are 100% moving higher. They are accelerating to the upside. Now, again, I understand rates are still elevated. I understand there's banking crises that are happening across the U.S. I understand there's a lot of global macro risk out there. I understand credit spreads are still elevated and blowing up higher. I understand that the bond market volatility, the MOVE index, is at levels that we haven't seen in several decades. I understand that, but the reality is there's nothing for sale in the Vancouver and most of these Canadian housing markets. Prices are, at least right now, in the very near term, they are accelerating higher. They are accelerating higher. That is now a trend that I am fully comfortable and confident in saying. Again, could that picture and change 3 months, 6 months, 12 months from now? Absolutely, it can change. But in the near term of the next 2 to 3 months, given where the supply picture is, prices are almost certainly bound to go higher. When you get 20 plus year lows in new listings and you have inventory levels at levels we haven't seen in several decades, and you open up the barn door for 1 million people to enter into the country, you are going to get, unfortunately, higher home prices. And that's very hard to actually wrap your head around, because you go, well, man, like, you still got to get stress tested at 7%. Borrowing a mortgage is, in a best case, you might get a rate of 4.7%. But that's the reality. And so I'd say it's surprising. It is definitely surprising. Like I said, given everything we've just talked about, I don't think a lot of people had this coming into towards the end of the year, when the housing market was I would call it depressed, when sentiment was horrible. Coming into this year, did I think that all of a sudden we'd see multi-decade lows in listings in what is supposed to be a busy time of the year for spring inventory coming to market, and to see a sudden reacceleration in home prices? Multiple offers are happening in a lot of the segments, particularly entry-level detached, entry-level townhouse, entry-level condo, basically anything that is relatively, affordable, or basically what people can qualify for when the stress test is 7%. They are piling into that segment of the market, and prices have been pushing higher. So, long story short, a very, very interesting development. We'll continue to monitor it as the weeks and months go on. That's the whole purpose of this channel. But if you're actively looking today, it's unfortunately a tight and competitive housing market. If you're a seller, a great time to get it on right now, especially if you're concerned about the outlook moving forward. But you really have no competition today, and we're seeing product that would have sat on the market 4, 5, 6 months ago, probably would have taken you a month to sell. You probably would have got a whole bunch of low balls. Suddenly you're getting 7, 8 offers through the door and a much higher price. So it is what it is. We'll continue to monitor the data as things change, but we've got an inflationary budget deficit. We've got changes to the housing front, and we've got a chronic undersupply of new inventory coming to market. And I'm not sure in the near term that we're going to have enough new construction, while completions, I expect, should be elevated over the next 12 months, which will help. They are still, it's an issue. It's a real issue. So hopefully all levels of government are paying attention to this. But this is the current development right now. So as always, see you next week.